You notice it at the grocery store first. A $3 carton of eggs becomes $3.79. Then your phone bill renews. The price changes by a few dollars. Your rent email arrives on the first of the month. The increase is dated, not argued. Your salary stays the same since January. News headlines argue about inflation causes. Markets swing daily. Experts debate intentions. But your payments change on schedule. Always on time. Always written. That creates confusion. It feels random. It feels unavoidable. Yet the timing is precise. The amounts are predictable. And the pressure is uneven. Some people feel it early. Others feel it later. That difference matters. Today we slow this down. We look at how pressure actually moves. Not opinions. Not blame. Just structure. If you think like a lazy investor, this matters. Because understanding timing reduces mistakes. And it raises better questions. Why do payments rise before wages? Why do contracts matter more than headlines? And who benefits when confusion lasts longer? At first, the claims sound dramatic. Banks shifting inflation sounds like a headline trick. Inflation feels like prices simply rising. Milk costs more. Rent renewals jump. Gas changes weekly. That feels messy and uncontrolled. Big institutions rarely move quietly. They leave paperwork. They leave announcements. Skepticism is healthy here. Complex systems resist simple villains. Central banks publish reports. Commercial banks follow rules. Balance sheets are audited. Interest rates are public. Payment schedules are fixed. So where would anything hide? Most people assume inflation comes from shortages or from excess money printing. Those explanations are familiar. They are taught early. They feel complete. When prices rise, wages feel late. Savings feel weaker. But that does not prove manipulation. It proves friction. It proves timing problems. The economy moves in layers. Some prices adjust daily. Others adjust yearly. Contracts lock behavior. People notice results, not process. That gap creates suspicion. It also creates exaggeration. This video avoids that trap. No accusations are made here. No secret meetings are assumed. We only look at structure. We look at incentives. We look at timing. We ask whether ordinary rules can shift pressure. If the mechanism exists, it matters, even without intent, especially without intent. Before connecting dots, we slow down. We check history. We check math. We check behavior under stress. In 2011, Europe faced a slow debt crisis. It did not arrive with panic first. It arrived with deadlines. Governments rolled bonds monthly. Banks held that paper. Rates changed gradually. The European Central Bank raised requirements. Not prices, requirements. Banks needed more capital. Lending standards tightened quietly. Mortgages reset on schedule. Variable rates moved with benchmarks. Households felt pressure later. Energy prices were already rising. Food contracts updated annually. Wages adjusted slower. None of this was secret. It was procedural. Balance sheets had to comply. Banks reduced risk exposure. They shortened loan durations. They favored assets with faster turnover. That changed cash flow timing. Consumers noticed higher payments before higher wages. Inflation felt sudden. The structure moved first. The feeling followed. In Spain, adjustable mortgages passed changes directly. In Italy, small businesses lost flexible credit. In Greece, tax timing accelerated payments. Each step followed rules. No emergency meeting was required. The outcome was stress concentration. Prices did not jump everywhere. They jumped where contract allowed. This is important. Inflation pressure did not spread evenly. It flowed through payment channels. People blame markets. They blame politicians. Few notice timing mechanics. The lesson is narrow. Structures transmit pressure before narratives catch up. That gap creates confusion. It also creates opportunity for misinterpretation. We hold that thought. Picture a normal household budget. One income, several fixed payments. Rent is due on the 1st. Loan payments hit mid-month. Utilities arrive quarterly. Food prices change weekly. Your salary updates once a year, maybe with a review. That timing mismatch matters. When prices rise weekly, stress appears fast. When income rises yearly, relief comes late. Now at a variable loan. The interest adjusts every 3 months. The contract allows it. Nothing illegal happens. The payment rises quietly. You do not renegotiate. You comply. Savings absorb the difference first. Then spending adjusts. You skip extras. You delay repairs. You feel poorer before you are poorer. Inflation is not just price level. It is pressure distribution over time. The structure decides who feels it first. The household does not see structure. It sees outcome. Bills feel unfair. Timing feels aggressive. but the rules were signed earlier. The pressure was scheduled. That creates a sense of surprise. Even though nothing changed suddenly. Now scale this up. Millions of households, similar contracts, similar timing. Pressure concentrates before wages move. Confusion grows. People search for causes. They point at prices. They misschedule. This analogy is simple, but it reveals something critical. Timing moves pressure, not headline, not intent. The same logic applies to institutions. That connection matters next. Banks operate on matching money in, money out. Timing is everything. Deposits can leave quickly. Loans return slowly. That gap creates risk. To manage it, banks use contract. Rates reset. Terms adjust. Collateral requirements change. None of this targets inflation directly. It targets balance stability. When central rates move, benchmarks move. Loan pricing follows automatically. Payment schedules update. Households feel higher costs first. Deposits reprice slow. Savings rates lag. That lag is structural. Banks protect margins during transition. They must. Capital rules demand it. Liquidity ratios enforce it. This is not strategy. It is survival logic. Inflation pressure shifts through these channels. Debt transmits it faster than wages because debt has schedule. Wages require negotiation. That difference is powerful. It means inflation arrives through obligations first, not through prices alone. The mechanism is boring, but effective. No announcement is needed. No coordination is required. Each institution follows the same rule. The result looks coordinated, but it is mechanical. Pressure moves quietly. It feels invisible until payments change. Understanding this changes perspective. It explains timing confusion. It opens a new question. Who understands this best? Cash flow explains behavior better than price charts. A household earns monthly. A business earns irregular. A bank settles daily. Obligations follow calendar. Loans have reset date. Bonds have maturity date. Deposits have withdrawal risk. When rates rise in March, not everything changes in March. Adjustable loans reset in April or July. Credit lines update after review cycle. Fixed wages wait for annual budget. That creates sequencing. Pressure lands where timing allows. A mortgage payment moves by 8%. Rent renews at lease end. Utilities update after regulatory review. Food prices adjust weekly. Income stays flat. Savings fill the gap. Then savings shrink. That sequence matters. It shapes decision. People cut spending before income rises. Businesses delay hiring. Banks shorten duration. They prefer faster turnover assets. This improves liquidity. It reduces exposure. It also shifts burden outward, not by design, by math. Numbers force timing. Timing forces behavior. This is why inflation feels sudden. The math moved earlier. The explanation arrived later. Market confusion grows in that gap. People react to outcome. They rarely see schedule. Professionals track calendar. They model cash flow time. They know when pressure appears. That advantage is quiet. It is not predictive. It is structural. The next question is incentive. Why the structure remains unchanged. Institutions respond to rules, not feeling. Banks face capital ratio, liquidity coverage ratio, stress tests. These are not flexible. When rates move, models update. Risk weights change. Loan profitability shift. Banks prefer assets that reprice faster. That reduces duration risk. It stabilizes capital. It protects solvency. None of this requires intent toward household. Incentives are internal. Survival comes first. Stability comes second. Customer comfort comes later. Pension funds behave similarly. Insurance companies, too. They match long liabilities with assets. When inflation rises, liabilities inflate. Assets must keep pace. Institutions shorten horizon. They demand higher yields sooner. That pressure flows out. Borrowers feel it first. Savers feel it later. This is not punishment. It is alignment with rules. Institutions that ignore timing fail. History shows that clearly. The system rewards compliance, not kindness. This explains consistency. Different banks act similarly. Across region, across cycle, the structure shapes outcome. Understanding incentives removes mystery. It also removes anger. The next step is history. This pattern is not new. This structure existed long before modern markets. In the 1970s, inflation surged across developed economies. Interest rates rose sharp. Wage contracts adjusted slowly. Mortgages reset faster. Adjustable loans passed pressure quickly. Fixed salaries lagged behind. Savings lost value before paychecks caught up. Banks followed the same logic then. They protected balance sheet. They shortened lending term. They raised requirement. None of this was hidden. It was documented. Yet most people remember price shocks, not timing shock. The pattern repeated in the 1990s. Emerging markets faced currency pressure. Debt denominated in dollars repriced instantly. Local wages did not. Households absorbed the gap. Institutions survived by enforcing contract. Again, No coordination was needed. Rules did the work. Even earlier, during post-war rebuilding, credit cycles behaved similarly. Inflation passed through obligations first. Taxes adjusted next. Wages followed last. The order stayed consistent. History shows repetition, not invention. Each cycle feels new to participants, but the structure stays familiar. Pressure moves through channels that allow movement. Fixed points resist change. Flexible points transmit stress. This is not moral. It is mechanical. Seeing precedent reduces surprise. It also reduces fear. When people understand repetition, panic weakens. The next factor explains why panic still happens. Humans respond poorly to uneven pressure. When bills rise before income, anxiety increases. Confusion follows. People seek explanations quickly. Headlines fill that gap. Markets amplify emotion. Prices flash red. Volatility feels personal. Yet the structure remains unchanged. Psychology reacts faster than understanding. Fear compresses decision time. People sell assets to regain control. They reduce risk without analysis. This behavior is predictable. Institutions expect it, not because they exploit it, because it always happens. Confusion creates forced decisions. Forced decisions create liquidity. Liquidity stabilizes systems. This sounds cold, but it is observable. Market stress reveals who understand structure. Those who do not react to price noise. They track obligations. They track timing. They wait. Panic benefits those with patience, not through advantage, through avoidance of mistakes. Psychology turns pressure into action. Action often locks losses. Understanding slows reaction. That difference compounds over time. The next question becomes critical. What is actually at risk when pressure rises? Most people confuse assets with structures. An asset is a thing, a house, a stock, a bond. A structure is the rule set around it. Payment terms, leverage, duration, reset dates. Inflation does not attack assets directly. It attacks structures first. A house does not change overnight. The mortgage payment can. A company does not disappear quickly. Its refinancing terms can. When pressure rises, the asset may remain sound. The structure around it becomes tighter. That distinction matters. Many losses happen from structure failure, not asset failure. Forced sales occur because payments cannot be met, not because value vanished. Margin calls follow rules. Loan covenants trigger actions. None of these ask whether the asset is good. They ask whether terms are met. Inflation accelerates this process. Costs rise faster than cash inflows. Structures crack under timing stress. Assets often survive later. This is why understanding leverage matters. Low leverage absorbs timing shocks. High leverage transmits them instantly. Institutions separate these concepts. Retail participants rarely do. They watch prices. They ignore obligations. That mismatch creates errors. People sell good assets to fix bad structures. Professionals restructure first. They extend time. They reduce exposure. They preserve optionality. This difference is subtle but decisive. Inflation reveals it clearly. The next section explains why panic amplifies this mistake. Panic compresses time. It forces action before analysis. Institutions operate on longer clocks. They plan quarters ahead. They model scenarios. Panic creates sellers. Sellers create liquidity. Liquidity stabilizes markets. This is not exploitation. It is system design. Markets require movement to function. Panic provides it. When individuals rush, spreads tighten. Price discovery improves. Institutions rebalance calmly. They meet obligations without stress. Panic transfers urgency outward. It relieves internal pressure. Again, no intent is required. The system rewards those who wait. Those who panic absorb volatility costs. This pattern repeats across cycles. It feels unfair, but it is consistent. Understanding removes surprise. It reframes behavior. Panic is not proof of danger. It is proof of confusion. Institutions expect confusion. They plan around it. Retail participants react to it. That difference explains outcomes. Avoiding panic is not courage. It is comprehension. The next step is time. Why deadlines change behavior more than prices. Deadlines change behavior more than prices do. A price can move and be ignored. A deadline cannot. When a payment date approaches, choices narrow. Options disappear. Inflation increases countdown pressure. Bills arrive sooner than relief. Loan resets happen on fixed dates. Tax payments follow calendars. Rent renewals are non-negotiable. Time becomes a constraint. People do not react to percentages. They react to dates. A 5% increase feels abstract. A due date feels real. This is why inflation pressure accelerates decisions, not because costs rise, but because time shortens. Countdown pressure reduces flexibility. It forces simplification. People sell what is liquid. They cut what is visible. They delay what is optional. This often locks in poor outcomes. Institutions understand countdowns. They design buffers around them. They ladder maturities. They stagger obligations. They avoid cliffs. Households rarely do this. They live paycheck to paycheck. Countdown pressure hits them first. That asymmetry matters. Inflation exposes it. The system does not need panic to function. It needs deadlines to be met. Countdown pressure ensures compliance. Understanding this reframes stress. The fear is not prices. It is time compression. The next section explains how professionals manage this differently. Professionals focus on mechanics before price. They map obligations first. They list maturities. They identify reset dates. They measure cash flow timing. Only then do they look at valuation. This order matters. They ask one question early. When is pressure applied? Not how much pressure exists. They avoid forced decisions. They keep liquidity buffers. They reduce leverage ahead of resets. They refinance early. They extend duration when possible. This creates time. Time reduces mistakes. Professionals also ignore short-term noise. They expect volatility during transitions. They plan for it. They do not react to headlines. They react to schedules. This behavior looks passive. It is not. It is disciplined. The difference is subtle. Retail investors chase prices. Professionals manage structure. One reacts to emotion. The other reacts to calendars. Inflation punishes reaction. It rewards preparation. This does not guarantee success. It reduces error. That distinction matters. The next section addresses common retail mistakes that break this logic. Retail participants often react to surface signals. Prices fall. News turns negative. They assume risk increased. Often, structure change instead. They sell assets to reduce anxiety. But selling does not fix timing problems. It only crystallizes losses. Another mistake is ignoring leverage. Small loans feel manageable, but variable terms change quickly. Payment shock arrives before planning. Retail investors also confuse liquidity with safety. Cash feels safe during volatility, but inflation erodes it quietly. The loss is slow. It feels invisible. That comfort is misleading. Another error is overtrading. Frequent action feels productive. It creates control illusion, but each action has costs, fees, taxes, timing risk. Professionals avoid this. They act less. They plan more. Retail investors also chase narratives. They adopt explanations that reduce uncertainty. These explanations are often wrong, but they feel complete. This creates false confidence. Mistakes compound under pressure, not from lack of intelligence, from lack of structure awareness. Inflation magnifies these errors. It compresses time. It forces decisions. Understanding reduces frequency of mistakes. Not all risk, just avoidable ones. The next section reframes volatility itself. Volatility is not danger by itself. It is movement. It reflects disagreement. During inflation shifts, disagreement increases. Some prices adjust early. Others lag. That creates noise. Many assume volatility signals collapse. Often it signals transition. Structure changes before equilibrium. Prices search for balance. Volatility reveals that process. Institutions expect it. They do not fear it. They budget for it. Retail participants often misinterpret it. They see loss potential only. They miss opportunity cost. Volatility without leverage is survivable. Volatility with leverage is lethal. That difference is structural, not emotional. Reframing volatility changes behavior. It becomes information, not threat. This reduces panic selling. It encourages patience. Inflation cycles amplify volatility temporarily, not permanently. Understanding this prevents overreaction. The next section steps back further. It looks at long-term perspective. Long-term thinking reduces timing stress. It does not remove inflation. It stretches response windows. When obligations are manageable, volatility matters less. Over decades, inflation appears in waves. Structures adjust. Systems adapt. Assets that survive do so because structures around them evolved. Long-term investors focus on durability, not short-term comfort. They expect drawdowns. They expect confusion. They plan for both. Inflation punishes those who need immediate certainty. It rewards those who can wait. This is not optimism. It is arithmetic. Time allows income to adjust. It allows refinancing. It allows compounding to resume. Short-term views magnify pressure. Long-term views absorb it. This perspective shifts focus from daily prices to structural health, from headlines to balance. The calm comes from understanding, not belief. The next section addresses risk honestly. Understanding structure does not remove risk. It clarifies it. Inflation creates winners and losers. Some assets fail. Some institutions misjudge timing. No framework guarantees safety. Awareness reduces blind spots. It does not predict outcomes. The goal is not avoidance. It is preparedness. Risk exists even in cash, even in bonds, even in patience. Each choice has cost. Knowing where pressure enters helps manage it, not eliminate it. Professionals respect this. They stress test scenarios. They accept uncertainty. Retail investors often seek certainty. That desire creates fragility. Inflation exposes fragility quickly. Risk awareness builds resilience. It encourages flexibility. It discourages overconfidence. The next section explains what signals actually matter during inflation. During inflation, facts matter more than commentary. Payment schedules matter. Reset dates matter. Debt maturity profiles matter. Cash flow timing matters. These signals show where pressure will appear, not headlines, not forecasts. Inflation data is backward-looking. It reports what already happened. Structures show what happens next. Professionals track these quietly. They watch refinancing volumes. They monitor credit spreads. They observe duration changes. They look at policy implementation dates, not speeches. Signals are often boring. They lack drama. That is why they work. Retail investors often ignore them. They feel too technical, but they explain behavior. When credit tightens, spending slows. When liquidity rises, risk returns. These are structural facts, not opinions. Inflation noise hides them. Calm observation reveals them. The signal is not price. It is pressure location. Understanding this filters information. It reduces reaction. It improves decision quality. The next section explains what does not matter as much as people think. Short-term price action matters less than believed. Daily market moves reflect emotion, not structure. Headlines exaggerate urgency. Opinions compete for attention. None of this changes obligations. Inflation narratives shift weekly. Payment dates do not. Central bank language changes tone. Implementation dates remain fixed. Many people watch commentary. Few watch calendars. This creates distraction. It increases error rates. Social media amplifies this effect. Constant updates feel informative. They rarely are. What does not matter is prediction accuracy. Being right early does not help if timing is wrong. Precision without structure fails. Inflation punishes noise traders. It rewards consistency. Ignoring irrelevant signals is difficult, but necessary. Calm thinking requires subtraction. Remove what does not affect obligations. Focus on mechanics. That discipline creates clarity. The next section shows why education itself becomes advantage. Education changes reaction speed. It does not predict markets. It explains pressure paths. When people understand structure, surprises shrink. They recognize timing mismatches early. They prepare buffers. They avoid forced decisions. Education does not require complexity. It requires clarity. Knowing how contracts work matters. Knowing when rates reset matters. Knowing leverage effects matters. This knowledge compounds quietly. It reduces emotional cost. It improves patience. It lowers turnover. Institutions invest heavily in education, training, models, scenario analysis. Retail investors often skip this. They focus on tips. Education feels slow, but it pays during stress. Inflation exposes knowledge gaps fast. Those without understanding react. Those with understanding pause. Education turns uncertainty into manageable risk. It does not remove discomfort. It reduces damage. Over time, this advantage compounds. Fewer mistakes matter more than perfect calls. The next section closes a framework. It explains how to think going forward. The framework is simple. Separate price from pressure. Separate assets from structure. Track timing before valuation. Respect leverage. Respect deadlines. Ignore noise. Focus on obligations. Ask where pressure enters first. Ask who must act soon. Ask who can wait. This thinking removes drama. It replaces emotion with mechanics. Inflation becomes understandable, not controllable, but navigable. The goal is not prediction. It is preparation. Calm comes from structure awareness, not from optimism. This framework applies broadly to investing, to personal finance, to career decisions. Time and pressure shape outcomes everywhere. Thinking this way reduces panic. It increases flexibility. It improves survival odds. That is enough. You do not need certainty. You need clarity. Inflation is not a mystery force. It is pressure moving through structure. Understanding structure slows mistakes. It creates space to think. Education is not about predicting outcomes. It is about avoiding unnecessary damage. Calm analysis is a defense, not a strategy. If this helped clarify pressure and timing, consider subscribing to Leo, Lazy Investor. Leave a comment below. What obligation affects you first when prices rise?